Hi, everybody. Constance Hunter. I'm the chief economist at EIU. I'm also on the NBER board, and I am thrilled to be here today. It's such an important topic. Um, I had prepared some remarks, and I actually am somewhat happy to see that some of what I'm going to say was said by others. So this will be a bit of an underscoring exercise. Um, but as I think about this panel and I think about the role of governments in providing economic data, I didn't realize I was entering a competition, but apparently I am. And so well, I had prepared remarks that said governments have been collecting data back to 3800 BCE, right? so, so this is a public service that governments have been providing for quite a long time, right? So ancient Mesopotamians gathered census data. And of course, the origin story behind the US federal labor statistics agencies like the BLS, that began in 1869 when Massachusetts became the first state to create a Bureau of Statistics. And then it started at the federal government level in 1883 when the Senate Committee on Education and Labor held hearings around the country on the state of labor strife and living and working conditions, right? So this became a public policy initiative and providing that level of public good. And as we think deeply about the constraints and possibilities of providing economic data, I think we have to start thinking about that role of public goods that David mentioned earlier in advancing society, right? And so this is in terms of our understanding of the impact of policy, the ability of our economic ecosystem to improve living standards over time by making data-based decisions, and of course, the benefit of government statistics as they are timely, transparent, and regularly compiled. Um, I did some research about various aspects of the agencies, and so in 2023, an OMB report on the statistical programs stated that the public, businesses, and governments rely on federal statistics data produced by the federal government statistical agencies, units, and programs to make informed decisions. Um, and I think referencing the article by Julia Coronado and Ellen Hughes Cromwick is also a great shout out that goes into more detail about how and why these data are used by business economists. Um, and of course, as again, as David mentioned, right, economic statistics are non-rivalrous, right, and non-excludable. And because of that sort of free rider problem, I think we can assume that the private markets alone would underprovide data as a public good. Um, and many firms may actually be providing data for profit, right? So we have, of course, the firms that found this valuable exhaust data, like an ADP or an Indeed. And then there are other firms who have private data and they've actually gone out and invested in creating data sets and compiling and gathering data sets that complement the government statistics. Um, and so if we think about the business imperative, right? The multiple on companies that produce data is about 26 times EBITDA, right? So we're talking about significant economic returns to providing data and providing high quality data. Uh, and again, that profit motive is wonderful. It powers a lot of things in our economy, but it really underscores why we also need this public good out there. Um, so the conversation we're about to embark on will delve into details regarding what can be done by private companies, what must remain under the purview of government, and how these two might interface with one another. So before I introduce Shan, who is heroically 13 hours ahead of us in Hong Kong and still on the line, I had a thought as we were talking about the collection issues this morning. And if I sort of think a year or 2 years in the future, the question I want to pose, and there's a lot of reasons no, but why this answer might be no, but is there any reason we wouldn't rely on AI agents to help firms collect the data within their own organizations and then pass it on to government statistical agencies, thereby reducing the burden of responding? Now, obviously, there's lots of things around agents that companies would want to govern, and they may actually want some air cover from from the government, either in mandating this be done or creating guardrails. But if I think about if there are frictions with regard to the effort it takes to respond to these surveys, this is one way we might reduce those frictions, and I could certainly see a future where that might happen. Okay, so let me introduce our panelists. So Shan, as I said, heroically 13 hours ahead of us. She is at Goldman Sachs and she is the chief China economist. Previously, she was senior China economist on the Asia economics team. And before that, Hui was a senior strategist on the global commodities team in macro research, heading metals coverage with a focus on China's role in global supply and demand. Prior to joining the commodities team in 2016, she was a mortgage strategist on the global markets team in New York, where she helped build the mortgage strategy and research coverage. He joined Goldman Sachs in 2011 as an associate and was named a managing director in 2019. She earned a BS in economics and biophysics from the University of Michigan and a PhD in economics from MIT. We also have Jed Kolko. I'm sorry, we're not in order of where everybody's sitting. Jed sent me the briefest possible biography, and it really does not do him justice, but Jed brings experience with economic statistics from both the public and private sectors. Currently, he is a senior fellow at the Peterson Institute and a senior advisor to the JPMorganChase Institute. Previously, he was Undersecretary of Commerce for Economic Affairs, overseeing Census and BEA. Prior to that, he was chief economist at the tech companies Indeed and Trulia. And he and I got to know each other when I was named president and he was serving on the board. We have also Chris Wheat. He is a managing director at JPMorgan Chase and president of the JPMorgan Chase Institute. His recent work has focused on helping policymakers understand the evaluation of household finances, small business finances, and changes to local economies in the wake of the economic disruptions brought on by COVID-19. His work has been cited by federal and local policy makers and covered in major and national and local media outlets. In addition to leading the Institute, he is invested in work on diversity, equity, inclusion at both the Institute and JPMorgan Chase overall, serving as a mentor, leader, and advisor to young Black professionals across the firm. He serves on the board of the Association for Enterprise Opportunity and regularly joins industry leaders and other experts as an economic policy advisor. And we don't have, I got this from the website, we don't have your official education, but he is more than adequately credentialed, and we are thrilled to have him here. And then Nikki, we are so thrilled that you were able to make it, and really just so glad that you're here on the first day back to work presenting. Nikki said she did her slides this morning at 6:30 a.m. So we have lots of heroes on this panel, and Nikki is a statistician with over 14 years experience in the federal statistical system. She has practical experience in data analysis, sample design, estimation, imputation, and other detection, and outlier detection, time series analysis, seasonal adjustment, non-response bias, forecasting, and machine learning. She is currently working on the construction reengineering initiative, combining data from alternative sources with survey data to improve the quality of construction statistics. So with that, I will turn it over to Hui. Do I need to do anything on this computer? No, fantastic.
Thanks, Constance. I'm sharing my screen. Let me know if you can see. Can you hear me and see the screen okay?
Yes.
Okay, perfect. Thanks very much for having me, and Jim and Karen invited me, and I don't stay up to 12:30 a.m. for a lot of people, but Jim and Karen asked me, and I'm delighted, I'm honored to be able to join this conference. The U.S. government shutdown and watching afar, this has caused or led to more focus on data and how to measure data and how to track economic output. Sitting here in Hong Kong, when I talk to foreign investors, we actually get the question about Chinese economic output, Chinese GDP. Is the GDP really growing at 5%? What exactly is going on the ground? we deal with those questions all the time. So perhaps I can show you sort of the challenges in measuring economic output in China and lessons we've learned or lessons we've sort of thought about and tools we accumulated over the many years at Goldman Sachs. First of all, just want to highlight that it is very important to track GDP in China. Why? Because unlike in the US, policymakers in the US will focus on inflation and employment. In China, it is the GDP target that's the most important KPI or parameter that policymakers watch. So on this chart, you see the red line, which is a young year GDP growth. That's what the leadership, the government focuses on. The blue line is what we constructed as a policy proxy. What it really means is summarizing monetary policy, fiscal policy, credit policy, housing policy into one z-score number. So the lower this blue line is, the more aggressive a stimulus you're seeing. So you see during great financial crisis in 2008, 2009, there was this big easing in policy. 2015, the big easing in policy. COVID is certainly a big easing in policy. These are market moving. When China eases significantly, it's gonna send shock waves in Chinese asset markets as well as global markets. But what's interesting here is that when you zero in on the 2015, 2016 experience, right, you see government easing policy dramatically, but you don't see GDP number moving that much. So this is where economists, China economists come in. We need to do a good job tracking economic activity because just watching the official numbers sometimes it doesn't give you the right signal, and you might miss that significant easing and market move during cyclical downturns. So this is why this is important to track GDP growth, but also it's very challenging to track GDP growth. I'm going to highlight 3 reasons why GDP numbers are very tricky in China. The first reason is, as I said, it's a target, it's a KPI for central and local governments. If you look at the left-hand side chart, used to be in the old years, if you add up the 31 provincial GDP numbers, you get a much faster growth than when you look at the national GDP growth. The reasons were, provincial officials may inflate their GDP numbers because that's how they get promoted. That's the KPI. But National Bureau of Statistics will take a haircut and adjust the local reported numbers and give you a national GDP. So this highlights because of the institutional setup, having a GDP target, it gives you a lot of distortions in the GDP official data. If you look at the right-hand side chart, that's just the manufacturing PMI in China. What's interesting this year is that you see an increase in the PMI in March, June, and September. What's special about March, June, and September? They are quarter and month. So when there is a GDP targeting each quarter around the quarter end, it's possible for factories to produce more so that they reach the GDP target. And conversely, the month right after the quarter end, you tend to see a slowdown in economic activity. So again, this is an artifact because of the GDP targeting and the institutional setup in China. The second challenge for us to track output is that oftentimes the government give you data, but there's a lack of detailed information on breakdowns or documentation explaining why the series may break or change or diverge. The example I'm showing here is the goods trade surplus. China has a very large goods surplus, but the blue line shows the customs data, the red line shows the balance of payment data. Around 2022, they seem to diverge, but it's unclear what exactly was driving that divergence, which has consequences for measuring GDP. The third reason is more technical. Lunar New Year in China is the most important holiday. Hundreds of millions of people travel back to home to celebrate the holiday. Factories are shut down for a few weeks. It has and if it happens on the same day every year, you can do seasonal adjustment. But the Lunar New Year can be sometimes first half of January, sometimes the second half of February. So it can distort your December data, sometimes March or even April data. So when measuring economic activity, that creates another headache. We try varieties of seasonal adjustment methods, but nothing seems to be perfect. Now, with these challenges, what do you do? Certainly, we track data very closely. One data we track is commodity demand, because if you can measure how much steel you're consuming, then you get a glimpse of what is really going on in the economy. Is it strong? Is it weak? Is it accelerating? Is it decelerating? And also different kinds of commodity demand can give you a glimpse of the structure of the economy. So for example, here I'm showing you the steel demand in China. The light blue line, 2019 before COVID, just as a reference level, and the red line is 2025 this year. We have weekly data, so you can track where it is going. Long steel is used in construction, so you can see how much it has fallen given the housing downturn. And that makes sense. The steel demand and construction activity is quite weak in this part of the economy. Whereas on the right-hand side, if you look at flat steel, this reflects manufacturing activity, and it is going strong, and year-on-year growth showing signs that will be consistent with export data, with what we know about China's industrial capacity. Another data we look at would be listed companies' revenue growth. In theory, that should be a correlation with nominal GDP, and it does. Although the correlation is not perfect, listed companies are different from not listed companies. But this is just as a cross-checking that economic growth, nominal growth is slowing down. If you see that listed companies' revenue growth also declining. And the other tool we leverage is just high frequency data. Anything we can get our hands on, we include them in our bi-weekly high frequency tracker. Here I'm showing you the daily property transaction data. And again, the light blue is 2019, just give you a sense of before COVID, what was the level of daily property transaction and how far we have declined over the past few years. The left is the new property sales and the right is existing home sales. We also show traffic data or ports, container throughput, or the coastal consumption data. So any high frequency data, daily or weekly, we monitor them very closely. They're no replacement for economic output, but we do want to make sure that we watch every signal to help us understand where the economy is. Now, the last part of my presentation, I just want to show you, in addition to tracking data, we also watch as proprietary indicators or some summary statistics. The first one is an older series called the Keqiang Index. This is from a former premier, Li Keqiang. When he was a party secretary of a northeastern province, he didn't trust the data officials gave him on GDP. So instead, what he does is to look at electricity consumption, bank loan growth, and railway freight volume. And then if you look at the average of those three, that's called Keqiang Index. And it is more volatile and shows a more pronounced cycle than the GDP number, which is the dark blue line showing here, rather stable and doesn't move that much, especially around 2015, 2016. Remember, I showed the first slide that around that time, the government unleashed a large stimulus package, but the GDP number didn't show anything. The Keqiang Index does show a material deterioration in growth around that time. The drawback of this Keqiang index is that economic structure is changing. So think about electricity consumption in the years where services sector growing faster, maybe the Keqiang index will underestimate how much the economy is growing. So the difficulty is that the Keqiang index is really good for the old economy, infrastructure, property, industrial manufacturing, but it might not be great for any economic activity that is not credit intensive, that doesn't use a lot of railway freight transportation. But nonetheless, this is one of the index we do track. The second proprietary indicator we use is called the GS Current Activity Indicator. This summarizes about 15 indicators ranging from PMIs to property to IP retail sales, import, export. So the benefit for use this series is that it is a summary statistics and it incorporates private data, not just government released data. But the downside of it is that you have to benchmark it against GDP. So it doesn't really deviate from GDP very much. If you look at it very closely, you see 2015-16, the current activity indicator showed more weakness than the official GDP sequential numbers. So we think this is a useful tool, but at the same time, it also has its own limitations. The last slide I'm going to show you is another tool that we use. It's called Import Implied Domestic Demand Proxy. The idea is quite simple, thinking about you are what you eat. So look at Chinese imports, because trade data you can cross-check with trading partners, mirror data. So whatever Chinese government is announcing on Chinese imports, you can cross-check with other countries' exports to China. In general, they are quite close, highly correlated. So what we do is look at the imports and then using input-output table to figure out different imported products. Are they typically used for consumption, for investment, or for trade? In that way, just think about if you're importing a lot of iron ore, then much of that may be used for investment. But if you're imported, luxury cosmetics or bags, that might be for consumption. So once you have the input-output table telling you the weights for different type of activities versus imported products, then each month we can track the changes in Chinese imported products, get a proxy for domestic activity. So the light blue line is the national account or official GDP implied domestic demand. The dark blue line is our estimates of import implied domestic demand. And you see again, 2015-16, the import implied domestic demand was a lot weaker than the official data was implying. So altogether, I'm going to summarize the years of covering China, watching the data and explaining to clients what is really going on. There's no perfect alternative to official GDP, but there are ways we can construct alternative measures and monitoring high frequency data very closely to have confidence on the economic activity on the ground. With that, I will conclude and stop sharing.
Thank you so much. That was excellent. And why don't I just go in order, Nikki? I don't know how to pull up your slides, so I'm gonna phone a friend. I'm also a little nervous to make anything go wrong. So do we know which deck is yours?
Yep. It's
Oh.
just my name on it.
Perfect.
All right.
Oh, there it is. Perfect.
Okay. Well, it's good to be with you guys today. Honestly, I've been waiting to get back to work, and thank you for Karen for inviting me to speak today. As Constance mentioned, I work in construction statistics at the U.S. Census Bureau, and today I'm going to be talking about a project we've been working on for a while, which is blending data from satellite imagery with our survey data to produce an experimental data product of monthly single-family housing starts at a division level. And I am definitely not the only person responsible for this work. We have a team at Census, also a team from Reveal Global Consulting that we've all worked together, and this would not have gotten to where it is today without the hard work of all of these team members. So the goal of this effort was to see if we could combine our traditional survey collected data with estimates derived from satellite imagery, with the goal of blending these together to produce that monthly single-family housing starts estimate. So this is kind of coming alongside our current construction indicator, which comes out in the new residential construction report. In the media, this is often referred to as housing starts. This report provides monthly national and regional estimates of housing units started, authorized but not started, under construction, and completed. And this is not just for single family, it's for multifamily as well. But the focus of our project is just single family. The source data for this is the Survey of Construction, which is a sample of building permits authorizing new privately owned residential construction. And we've got a variety of data users for this product across government, private sector, and so on. So our current sample design is a multi-stage sample design. So we start with the sample of PSUs. These PSUs are counties or a union of neighboring counties that are in the current population survey. So this survey relies heavily on field work, and the fielding period for the CPS and for the survey of construction are the opposite parts of the month. So we use those same field reps. So we start with their population, their sample of PSUs. From that, we subsample that. From that selection of PSUs, we select permit issuing offices or non-permit areas, but most of the country requires a building permit to get started. So that's going to be the focus of this project. And then from those building permit offices, we select a monthly sample of permits. And the aim there is to get a roughly 1 in 50 sample of all single family permits. So with our satellite collection, one of the big advantages is it eliminates that third stage of sampling. So rather than follow up on 1 in 50 permits for a sampled area, we're able to observe all construction activity in that area. Another advantage we see for satellite data collection is the reduction in respondent burn-in. So we are sampling permits, and so our field reps are contacting that builder to ask, did the house start? And a lot of times the house doesn't start in the month that it's permitted. So they might have to make, a call that month, a call the next month, a call the following month, and keep calling that builder to get information on when that house actually started. New residential construction activity because we wanted to be able to observe a lot of housing starts. And we get their tiger line shapefile, so that defines the area. And we kind of augment that, basically simplify the area. So like the original shapefile you see on the top, our adjusted shapefiles on the bottom. So it looks pretty much the same, just smooths out some of the edges. And we provide that shapefile to an image broker and say, we want to task satellites to this area to collect those images on a monthly basis. We do give them a 10-day capture window to actually get those images, so 5 days on either side of the end of the month to give us the greatest chance of actually getting images. So once we get those images back, then we have to develop a construction stage model to classify these different stages of construction in the image. So here you can see a big construction site. We are trying to identify these 8 construction stages, from background, land, vegetation, which would be pre-construction stages, through the various stages of construction. So after we collect those lots of images, we had to do a massive labeling effort. So kind of paint by number, go through and identify on the screen where you think there's a excavation, a foundation, framing, and so on, and just label all of those. So spent lots of time labeling, so as the rest of our team. And then we use those labeled images to train a convolutional neural network model. So that's a typical model used in computer vision applications. And from that, we can feed it new images and it will predict what it thinks the construction stages are. So on the left here, we have the raw image, and on the right is what we call our prediction mask. So it is predicting at a pixel level what it thinks each of the, each pixel is in terms of what's its construction stages. So you can see, I don't know if you can see my mouse. Oh, there we go. So we've got this light blue area, which is land, and then we've got this purple blob right here, which would be framing, and you can see that corresponds to framing over here. And also we've got a foundation here, and there's a foundation right there. So that's the general idea of the construction stage predictions. So the next stage is to try to count up, on that image, how many starts we saw, how many of those new construction sites are actually on that image. And so initially we wanted to use parcels. If we saw a new construction in this parcel, that counts as one. The issue we ran into with parcel data is it very quickly becomes outdated. It doesn't, parcel data is publicly available, but it's not always updated with the frequency we need. We're trying to do this monthly. Partial data might be updated once a quarter, twice a year, something like that. And so, there are cases where the parcels would be correct and we would be fine, like you see in this portion of the image. But as you can see, this large red area here, that is currently one parcel in our data. And you can see there would be multiple construction sites there. So we quickly realized that parcel data was not going to be the way forward for us. So instead, we're using a method called blob search, which basically it's what it sounds like. It identifies collections of units of pixels with the same classification and identifies that as a blob, and we can track that blob over time. And so what we're looking at is you're taking this image from 1 month, comparing it to what we see in the next month, and we're looking at the construction stage of that blob going from this prior month to the current month, and then determining whether that's a housing start or not. So, our determination of whether it's a start or not comes down to basically these business rules. If you move from one of our pre-construction stages of background, land, or vegetation to one of the construction stages, we would consider that a start. If you go all the way to a roof, we call that a start completion, but that would still be included in the starts calculation as well. So then our next kind of task was, okay, so we've identified new construction. How do we know it's residential construction? A foundation for a home might look a lot like a foundation for a restaurant. So how do we know that this is actually a residential construction? So we developed another model. We have another classification model. We call it the building type model, which classifies, broad areas by likely building type. So we have several categories that we have been labeling: single family detached, single family attached. That's basically townhomes, but those are included in our single family numbers for our indicator. Multifamily, non-residential, and background. And background is basically like trees and things that are not buildings. So we did another labeling effort. This is at a much larger scale. It goes a lot faster because we're labeling like blocks and neighborhoods and not individual homes. And so that gives us another model with another prediction mask. So you could see that light blue here is identifying non-single family, and so that's capturing this kind of shopping area here. That royal blue is capturing these single family detached neighborhoods here. And on this construction site, you see like we've got some mixed classifications. It doesn't quite know if it's non-single family, if it's single family detached, or if it's background. But usually once we get 1 or 2 starts in that area, it pretty quickly switches over to single family. So then we've got another process. After we do the building type, we've got another process that we do to help reduce some of the noise that we see. So one of the classic example that I like to give that came up a lot is that we have an image with a tree over the roof of the house. And our satellite image looks at that and sees vegetation, and our prediction is vegetation. Then the fall comes around and the leaves go away, and now we see the roof. And so we've got a classification of vegetation to roof. That's a start, right? But we know this house has been here for a long time. So how do we weed out those false positives, basically? Well, there's publicly available building footprint data. and we import that and use that. So if we have a start blob that's overlapping with an existing building, we just exclude that from our count because we figure that's noise, that's building is still there. We also do a similar process overlaying our start blobs with roads. There's, publicly available road data. So if we have an overlap with a road, we also exclude that. With satellite data, we can also have missing data, just like we do with survey data. And so missing data, when it comes to satellites, comes in the form of clouds. So a lot of times, even though we have a 10-day window to collect the images and we're trying to get cloud-free images, that doesn't always happen. So we have cloud cover. And so we had to develop some imputation methods to deal with that cloud cover. And we know that construction is not evenly distributed across an area, like a city. It's usually clustered in very specific areas. So we didn't want to use our imputation, if we collect 70% of this area, to just do some kind of ratio adjustment. We wanted to focus our imputation at a more granular level. So we're using the 7-character geohash. Geohash is just a standard unit of measurement of geographic data. And so this works out to be kind of like a block size area. I mentioned earlier that we have this 10-day capture window. So ideally, the time between our images, we have to compare the prior month to the current month to identify a start. Ideally, that is exactly the length of the month we're trying to measure. In reality, that may not be the case. So in this example, we're looking at April. Ideally, we get that first image, the prior month image on March 31st and our April image on April 30th, but we could have a situation where we got the March image on April 3rd and then the April image on April 28th, and that's only 25 days. So we have to do an adjustment to make that time between images reflect the actual month we're trying to measure. So that's a pretty complicated satellite data flow, but after all of that, what we get is an estimate of the place level starts for that place from the satellite data. But that's just for one place in our entire sample. So we didn't collect, all of the units in our sample by satellite, just a subset. So we're combining those satellite estimates. We summed them up to get a satellite estimate. We got our survey estimate from the remaining places that we're still collecting with our traditional methods. So when we think about trying to use these data in our estimation method, as I said, we are sampling permits from that permit office. So we have information about the month that permit was authorized. And we use that in our estimation methodology to kind of control those totals to the building permits totals from the building permit survey, which is a very reliable count of all building permits, because since 2022, that's actually a census of all units issuing more than 6 permits annually. So we feel really good about that number. That's why we control to it. However, with the satellite data, we don't get any information about what month that observed start was authorized. So we can't just plug it into our existing estimator. So we basically combine the two together. We just have our satellite piece, which is just the sum of the satellite estimates, and we take our existing methodology for our survey-based estimate and just pull the satellite places out of it. Just pull them out of the BPS control totals and pull their data out of that entire process. So what this has resulted in is an experimental data product for the West South Central Division. So that's a more granular geographic data than we currently do. Currently, our most granular is at the region level. So this is for the West South Central Division. This is like Texas, Oklahoma, Louisiana, and Arkansas, I think. We've produced this from, we first published last December, including data from July to November of that year. And our most recent data is for August of 2025. If you want to check it out, there's our website. And then moving forward, we have a lot of ideas of how to expand this. And this is not, currently a production method. This is for the experimental data product. But we're looking at expanding our data collection out of just that, West South Central Division through the rest of the South. So the South is going to be our first target to move to a regional level. We're also working on improving our single family attached measurement. That is part of the single family estimate. And right now it's kind of difficult to identify how many units are in those single family attached construction sites, but we're working on methods to improve that estimation. So if you have any questions, here's my contact info and that for the satellite project. Thank you.
Thank you. That is exciting and very interesting. I will add, having built a house, it is not done until there's grass. There's no grass while you are building. Like, it's impossible to have grass there because they're digging, all sorts of trenches for sewage and plumbing. And so you wait, and not until you have grass is it completed. Um, I think I'm going to alter my rule, though. I think we had agreed Chris would go and that Jed, you would wrap everything up if I'm remembering correctly. So, Chris, I'm going to pass the microphone to you next.
Had an aspiration of talking while trying to open stuff, and I'm not that good at technology. Okay, so I am going to try to take the deck that I sent before today and pull out the pieces that I think are additive to the conversation that we've already had. And so that may make for a shorter presentation, which might be good because I think we only have so much time, and maybe leave some time at the end for questions after all of us finish up. I'm helped in doing that because some of the comments that I wanted to make about this competition about like how far in time can we go back, and understanding sort of the institutional structures around the production of economic data, I think is really interesting. I was thinking about that. I was like, I'm going to say something about that. There's no way I can have anything additive to say to that conversation in terms of filling out the history, other than maybe to briefly note that I think it's really important to think about why data are being produced. Like, they are, I think it's fair to say, like in all of those stories, there was a within the mandate to sort of broadly produce data to kind of generally answer questions about the economy. There was like a war that had just happened, and there were some questions I think that were driving some focus to which pieces of the economy we're trying to measure and why. And I think there's some through lines when you try to think about how private sector entities are running their business in ways that produce, Jim uses the term exhaust data, I lost it over there, a lot. I mean, like, it's true that there's stuff that's being produced that's relevant, but you really want to think, I think it's really important to think about what is the process that is generating these data. So I'll talk a little bit about that. I will also just very briefly again note that was a super interesting presentation, and I have lots of things to reflect on comparing what it looks like to invest in producing data for the purposes of producing data. I'm like, I'm just thinking about the number of people hours that went into this like preliminary project and contrasting that with what we would typically spend as a relatively well-resourced private sector entity that kind of has a similar-ish mandate to be helpful in helping economic policymakers think about data and the economy, but it looks very, very different. Even just sort of I mean, see lots of what your colleagues do and what you've done in the past. But it was just a very salient reminder as I sat here listening to the presentation about like what those differences look like. Um, I'll briefly just introduce the JPMorganChase Institute to those of you who are unfamiliar with it. I see many colleagues and former sort of partners in many projects around the room. But for those of you who have never talked to this about before, in broad terms, JPMorganChase Institute, founded about 11 years ago at this point, with that goal of taking the customer and client data that we have across the whole business, at least theoretically, and trying to use that to generate insights that are helpful for policymakers who would otherwise not be as informed about the economy as they might be. Like, that's, in so many words, what we do. 99% of what we do is produced for public consumption. We of course have conversations that are internal and help people understand things that are relevant to the business, things about the data that we see that they don't see, things about how to organize the data. But mostly what we're doing, we're in the business of creating public outputs that people consume because, again, our mandate is for helping people understand what's happening in the economy and make better policy decisions. There's lots of stuff that we have access to. You can see, I'm not going to read all these things. I mentioned the different kinds of work that we do, to kind of emphasize that we're not principally in the business of generating data to be consumed as much as we are trying to answer questions about the economy. Just the same, over time, we've kind of gone a little bit back and forth in thinking about how much is providing forms of data serving that goal, and exactly how should we be allocating our resources to things that are more like data series production versus things that are more like research that is about the economy. And so that's a little bit of what you can see on this page. Um, uh, on a panel about output, I think the first thing that people think about is, hey, don't you guys have a lot of like credit card data? It is true. Oh, you're a large credit card company. For those of you who are customers, thank you very much for your business. We do have a lot of credit card data. We also have debit card data. But you might infer from the broad set of things that we do research on that we have lots of other data. I think some of that data is also important, even narrowly to measuring output. Of course, the context around output I think is really important as well. And if there's a through line through all of this, I want to make sure that people understand what it is that we have done and could do, in part to inform a question about like, or a conversation anyway about like, but how, what might the role of the private sector be in not just like providing data that are inputs to filling in gaps around concepts that we have measured over a long time, but also introduce the possibility of thinking about different concepts and like how does that fit together? So that's what we're going to try to do, and I'll try to be brief about it. This slide is titled saying debit and credit card data could provide a granular view and timely view of spending. This is, I think, kind of the conceit that I mentioned before. I think it is obvious to anybody who's thinking about these questions that it could be useful to have, in particular, data from credit and debit cards as a view on spending. Why, to the extent that it is not obvious, in theory, those data could be available really quickly. Like the bank obviously knows as soon as you swipe a card, how much did you spend? We know who we know some things about you. We probably know about where you live. We might have an idea about your gender. We definitely know your age. We might know other kind of demographic things about you. We might know where you swipe that card. So we might have an idea about the locus of the activity. We will know something about where you spent the money. We'll know like the merchant, and as a result, we'll know, industry roughly. Let's just call it that. We won't necessarily know the product. We won't know the price. But we will see the dollars that were kind of, Chris Wheat this morning spent $9 at McDonald's on the way here, right? Like you'll know that. And so that gives you this very sort of theoretically quite granular view that could be quite low latency is the phrase I've been using of art to understand what's happening with spending. I have here in the title components of spending just to remind people about sort of like what you don't see anything through these data that's not on a card. So most people don't buy, they don't pay rent on their card. They don't buy houses with cards. They don't buy larger things with cards. There's lots of payments that are not going through this channel. So it's a view on output, but it's not the whole thing. The other thing I would note, not at all in passing, the time series of this chart ends somewhere, a few years after the pandemic or after the onset of the pandemic. Uh, we used to spend a lot of time and money and people time investing in generating a data series that was quite localized and with the intention of being relatively low latency. We stopped doing that because it was hard for us to make the case to do so in the way that we were doing this. So there was I think, as it's like, reduce the data when it's not interesting. I was like, I hear you. But we'll talk offline, or maybe we can have a conversation about that because it's really interesting. Like I totally understand the value of producing the data all the time. Like how would you know if it's going to make sense when things are different if you don't see what it's like when things are regular? Like it totally makes sense. But again, when you think about the incentives of everyone, but in particular a private sector producer, again, relatively well resourced, but not infinitely resourced, without the staffing to generally do this, like it's hard. You have to really make sure you've nailed the business case, and it is there's a more compelling business case when things are dynamic and changing. So things are dynamic and changing now. We continue to have an aspiration of doing this kind of work. We hope that sometime in the near future, you will be like, I remember Chris Wheat said that, and now I see that there's something that helps me have a view on spending. I think that we have thought about how to do this better, but I just wanted to note some of those challenges. Other things that we can do that I think are relevant to understanding output. when people get paid by direct deposit or things like that, or maybe it depends on how we want to measure it. There's a lot of ways we think we can get a view on through your checking account, how much do we think you got paid? In this particular chart, this is from a more recent release, actually the most recent thing that we released, I think, a couple of weeks ago. We wanted to look at income growth. We've been looking at income growth for a long time. We just thought it was a good time to do an update. You have the benefit of a long time series here. You can see this kind of goes back a long way. This is looking at median income growth by age as we see it. Again, to illustrate that we can, like have a granular view of an income-like construct. But of course, I say income-like construct. This is conceptually, you might think about it as take-home pay. Mechanically, it's dollars coming into a checking account minus those things that we think are transfers into an account. Like, not everything that comes into a checking account is income. Not every transaction is labeled income. But if we see cash coming in, for most people, that's probably income. If we see a check, but we don't know exactly who the check came from, that's probably income. If we see a transfer between accounts at our bank or from another bank, we're like, that's probably not income. And transfer, if we see a transfer from a money market account, a brokerage, something like that, right? That's probably not income. An income-like construct in changes most of the time. Do we think that that is an informative signal about a component of the labor market? Yes. Is it exactly is it changes in wages? Again, we tend not to see price and quantity. We tend to see sort of price times quantity. So we can't tell you about wages. We could maybe tell you about how many jobs. We see two different transactions. Maybe that's two jobs, but maybe that's two people in the same household in a joint checking account. Our lens is informative but not perfect as it compares to products that were designed to answer exactly this question, or maybe the view might have from another private sector entity, for instance, one that has payroll data. I'm presuming, I don't know, Naila sounds she had a meeting, but right. There's other sources that maybe you could combine to get a more complete view. The last two things I'll share are more, again, to make the point that banks writ large, ours in particular, but lots of large banks presumably could do this, have other payment data that I think is quite important to filling out the view on what is happening in economic production as it relates to outputs. Of course, like consumption is a very big piece of GDP, and so it's like I understand why people are quite interested in that. But we also bank small businesses, right? So we're seeing in the way that we are seeing transactions in and out of checking accounts, credit card payments, et cetera, for households. We also see those for small businesses and medium-sized businesses, and the bank sees them for large businesses, along with all of the other payments that we manage domestically and abroad for larger businesses. Here, this is most, I mean, I could tell you about this particular research study, and I'm happy to answer questions about the study. More the point here was that we can measure revenues, we can measure expenses, we have some view of payments along the supply chain, from quite far upstream before they hit consumers, or to the extent that small businesses are actually part of the final demand. Our lens is not just on consumers. We have lots of payments that properly structured could help people understand, properly structured and understood sort of what we are and aren't seeing could help people understand production across the economy. And so too, I'll be even more brief here. We had done some work earlier this year trying to understand the impact of proposed tariffs on middle market firms, because we had expanded our data footprint within the firm to look at transactions here, payments into and out of, in this case, into US-based middle market firms. Here, the point being, we have some view on what the exports look like for firms of a certain size once they kind of get out of our smaller business platform. Again, you can have views of output relevant components of economic activity that aren't just about spending, and I think that financial services institutions writ large, again, conditional on can we make the figure out the right way to share the data, get the incentive right, all of the things that have come up earlier today. So again, my goal here was really just kind of illustrate a view from one bank that has made investments in trying to facilitate exchanges with policymakers, with people trying to understand the economy, noting many, I don't think I need to read through this list of limitations because I think that they've been covered by others probably as well as any. We have the markets that we have. Any firm is going to have an incentive to service certain markets and client segments and not others. Like, it's how you do business, how you run a profitable business that has the slack, as it were, to do this kind of work. It's going to change over time because the business practices is going to change over time. If you want a really, really long time series, that's going to make that challenging. And then again, just whatever model there is of data sharing is going to have to contemplate very heavily both the structure and the dynamics of the firm's incentives over time. So one would need to give thought to that. On the consideration side, I mean, really the one thing I wanted to highlight was just this like food for thought question that has been spinning in my mind, not just because of the last month, but not because of last month. Really pressing that question of like, if there was just a lot less support for, I mean, I think all of us would like to see more support. Chris Wheat would like to see more support for public statistics because they fill in all these limitations that you see on the left side with private sector data. So that's what I'm saying. And if those supports continue to fall away, like, well, what would it look like? Would you answer different questions maybe with private sector data? It would just, I think, be interesting to really take a hard look at how economic policymaking and planning might look different in a world where there was actually a lot less consistently produced public sector data. That I'll finish.
Thank you. Jim, can I have a time check, please?
I think you're going a little bit into lunch.
Okay.
Yeah.
And Jed, I saw your slides here, and now I can't. Oh, there they are. All right, so that is run a little bit into lunch. So we're talking 15 minutes, 10 minutes. Okay. In
Right.
10 minutes or fewer.
Thank you, Elle.
Please.
Put myself on 1.5x. Pleasure to be here. Part of what I hope to do in the last few minutes in this session is to reflect a bit and underscore a couple of points that have been made in passing. They have been used to frame some of the discussion so far, but want to really sharpen this question about what the private sector is best geared to contribute, and what are the parts of statistical economic statistics in the statistical system that is much harder for the private sector to deliver. This is a panel that was sort of structured around questions around output, and I think the special challenges of measuring output really highlight the role of both blending and coordinating data that underscores so much of the value of our public statistics. So I will basically get to the punchline that is this. The private sector can do a great job at filling gaps in official statistics for what I'm going to call single origin data products, but not for blended data products and essential coordination activities. Now I'm going to continue on with this distinction between single origin and blended. You might prefer single malt rather than single origin, depending on what your personal vice is, but I'm going to stick with the coffee and chocolate single origin. So very crudely, reducing a lot of important continuous distinctions into a simple binary. When I say single origin data products, I simply mean those that are based primarily on one survey or data set. Each half of the jobs report is a reasonable example of this. Of course, there are other inputs, but as an extreme type, as opposed to blended data products, where GDP is the obvious most blended example. So are the price indices. Lots of inputs from many sources that go into CPI and even more so into PCE. There are different agencies within the US system that are at the sort of core or own the leading expertise for each of these kinds of products, though of course they all work on all of these kinds of products. When you think about where the premier survey methodologists are within the statistical system, and the agencies that are really thinking in innovative ways about how to bring in new methods for data collection, I think of Census and BLS, whereas BEA is the agency with leading expertise in thinking about blended data products. How do you produce essential principal indicators that are essentially based on inputs from other agencies? Now, my preferred metaphor, since all my preferred metaphors come from food, is farming versus cooking. Now, you could also, in a more sophisticated way, think about the important single origin data production skills as being a little bit more on the micro and data science side. Whereas the blended skills are a bit more on the macro and accounting side. Again, I don't want to sort of force every agency or every expert into one or the other. It is a more continuous theoretical point that there are these single origin data, largely single origin data products and largely blended data products. And just in case you aren't that deep on GDP, it is the ultimate blended data product. Given this is a panel about output, this is the excuse to talk about this. These are only the principal sources for the quarterly estimates of GDP. There are other sources. There are more that go into the annual. There are more that go into the comprehensive revision. A lot goes into the blender in the production of GDP. It is very, very different from the sort of the other extreme example of a company that produces a data set perhaps as exhaust or incidentally, and is then able to develop a useful economic indicator that still comes from entirely within the confines of that data set or from a survey. Very related to blended data products are essential coordination activities that happen across a statistical system. And this is now moving not just from a given blended product, but the way in which the whole range of data products get coordinated across a statistical system, including the single origin products. These coordination activities include determining taxonomies and definitions, geography, industry, occupation, race, and ethnicity, a lot of accounting harmonization questions. The BEA worries a lot about these, rightly, about how to count activity once and only once, making sure that something that is counted in this quarter is not also counted in the next quarter, that things happen on the right side of a boundary. And then, of course, there are all the coordination activities around engagement, production, and publication. All of the rules around when indicators come out, when the administration can speak, and so on. This coordination, of course, happens across US agencies. For some products, it also happens internationally around NEPA standards. Green GDP was mentioned earlier today. There's a lot of international coordination around natural capital accounting, given that dates and boundaries get especially complicated when we're talking about the natural world. And so both these blended outputs and coordination activities are a critical part of the statistical system. They also require a very specific set of skills and resources. And of course, getting back to the punchline, these are skills and resources that are more likely to be things that the public sector has or invests in or can do than any one company. So first, deep and broad expertise about a range of data sources and standards. Most private sector firms are rightly not that enthusiastic about talking about data that is not their own. This is probably good, but we do need organizations who are very comfortable talking about the range of data, weighing them, criticizing them, combining them. Cooking skills for harmonizing, aligning, combining data. I mentioned BEA. We heard from Nikki, that there are lots of products, including experimental ones, that require a lot of sophisticated methodology about how to combine and align data from different inputs, in this case, very, very different inputs of satellite imagery and direct surveys to combine data. You also need the credibility and independence to make unbiased methodological decisions. On a panel earlier today, that was emphasized that a lot of the difficult decisions about how to combine data into a final measure requires decisions, and anyone providing input into that needs to trust whoever is the blender or coordinator of this. You need convening and enforcement power. That is something that the public sector has, that no private company is likely to have in the same way. And of course, the right incentives, as has come up often today. A lot of these blending and coordination activities really create positive externalities. Everyone's data is more useful, private or public, when it can be combined with other people's data. When you've got activities that involve positive externalities in public goods, that is something that the private sector might not produce as much as we want. Now, behind all this conversation, there is this sort of nagging question of what happens if the public sector doesn't have the funding or resources or expertise that it historically had. So I was thinking about what are the institutions that have done these blending and coordination alignment activities. Some, obviously, some very important ones are within the statistical system. I keep mentioning PIIE as the example around GDP and other NEPA measures. The chief statisticians team within OMB OIRA does a lot of this harmonization and alignment work, including about process. Also within many other agencies, not just PIIE, in the statistical system, there are technical and standards teams that I think a lot about Census and all the reasons I go to the Census website that have nothing to do with downloading a data set, but go to things like all of the geography tools and the shape files, statistical, seasonal adjustment X13. Outside the statistical system, there are some of these institutions, public nonprofit NGO, the Fed for sure, including regional banks. One of the nice things about the Fed is they are happy to dig into others' data. I think the labor market indicators is an excellent example of something that is a blended/harmonized product. It is not a single origin private sector style indicator. And something that the Fed is much more likely to do than any one company would do. National Academy's CNStat is another example. Of course, the international multilateral organizations, very important for a lot of the international harmonization, and academia and the Bureau. All essential, particularly if, for whatever reason, there may be fewer resources or less expertise from within the statistical system. It is not just a question of where do we get these essential single origin data products from, but how do we develop the blended data products and do all the coordination across these activities that's essential for the system. It is unclear how far the private sector would or could go on the blending and coordination side. We did hear the example earlier in this session from Hui around their China research and Goldman, JPMC, and other macro teams do some of this blending work in coming up with, Hui mentioned the current activities tracker. Other firms do too, but even within a place like JPMC, that work within the firm happens in a different place than the institute work that Chris was describing. So even there is this distinction between the more microeconomist data scientists versus the macro folks who are focused a bit more on these harmonization alignment questions. In the end, this is yet another reason for the importance of the public sector and official statistics. The conversation shouldn't just be focused on how far can the private sector go to fill in some gaps in the single origin data products, but rather thinking about the whole system and where the blending and coordination activities will also have to continue to come from. Thanks.
Jed, thank you. And thank you to everybody on the panel. Hui, I don't know if you're still there. I'm looking at the TV, but thank you very much for staying up so late for us. I'm so glad we got our technical issues resolved. And with that, I think that concludes this session. We don't have time for questions. Oh, we can take a few questions. Fantastic. I was trying to keep us on time. Okay, we can take a few questions. There are microphones in the room, and I will watch here in case anybody raises a hand online. And please just say your name, even though we probably in the room know who most people are.
Yeah.
But
Okay, Karen Kimbrough at LinkedIn. I want to say, first of all, thank you to all of the presentations, fascinating and really helpful. I was thinking a lot, Jed, actually about the points you were making on one of your slides around taxonomies. That's something, for example, that we spend a lot of time on in our taxonomy. And I was wanted to just get your, here's what I observe, and I want to get your reaction. I observe that, like, for example, a taxonomy that we have for occupations is far different than what the government has. And so it's capturing different things. I don't know that ours is better, but I probably would argue that it is. And I just want to hear your thoughts on where the private sector has the opportunity to like push the public sector to innovate faster, as opposed to just being a complementary input to that blending. Does that question make sense? Yeah, thank you.
Oh, yes, that question makes lots of sense. Anyone who has worked with private sector data probably sooner or later has sort of encountered the taxonomy team in the company in which you work or some equivalent. This is a huge deal. I think it actually goes in both directions. One of the advantages, of course, that the private sector can have is to be much more nimble in updating taxonomies, changing their own taxonomies. When I was at Indeed, we had a category for data scientists long before data scientists ended up as a category in the sort of official occupation taxonomy. And of course, private companies rightly will be optimizing their own taxonomies for business purposes. At the same time, official taxonomies need to fulfill lots of needs. It is really important that they are fairly stable over time. We actually don't want official taxonomies to change that quickly. We want to make sure that they can be mapped backward and eventually forward. I think so I think of the challenge as less how can official taxonomies be more agile necessarily like private ones, and more about how can we stress the importance of taxonomies in the first place. Nobody's going to win a big award for like their innovation around data infrastructure and taxonomy, even though I often joke that like I did a PhD in crosswalks. But I just want to underscore like, yes, in every setting, people worry about this. The one distinction I would make, though, occupation industry, there is lots of change. When it comes to geography, could everyone please just stick with like standard government geography, include FIPS codes, numeric FIPS codes in your data set? There is no reason to be making up your own geographies. Thank you. Personal views only. Thank you.
So we're gonna go to the room's right-hand side microphone just to alternate.
Hi there, Jason Faberman, Chicago Fed, First Jet. I 100% back you up on that. But I had a question for Nikki. So the housing starts data, the stuff you guys had there is, number one, is very super cool. But also someone worked with the stats agencies and so on for quite some time. Being cognizant of budgets and so on, it also seems, well, to me at least, pretty expensive in sense of both how labor intensive it seems, how data intensive it seems, data storage intensive. I was wondering, could you maybe, I don't know if it's possible, like give us a sense of how much inputs and resources kind of went into it and how much kind of relative to the standard current ways of collecting the housing starts
Can I
data.
just follow up on that because I had the same question. So you have to buy the satellite data. How expensive is it? And secondly, how much of what you described is manual and how much is automated and AI doing the work?
Okay, so I'm going to disappoint you guys because I do not have the budget data on that. That's above my pay grade, as they would say. I'm like the methodologist, so I'm figuring out how to combine these data to do the estimates. But I will say I know people are looking into that, and I don't think that we would have continued the project this far if they didn't think that there could be a return on the investment. I think the hope is that down the line that we could use the satellite data collection method in place of the field reps for starts at least. And so I know that analysis has been done and they're encouraged, I guess, to continue, but I can't say anything about any like dollars and cents because I just don't know. In terms of how much is on a monthly basis, how much is automated versus manual. So on a monthly basis, it is, the satellite part, I think, is almost all automated at this point. Like we get the images and all that classification work is running on our contractors, their servers, and they get the images, They run the classification models and everything that goes with the satellite things. And what we get back is a spreadsheet with the location and the number of starts. There's some other variables in there, but that's essentially what we get back. So like in terms of all that classification stuff, that was all the manual stuff was to train the model. And then on a monthly basis, we just put it in the model. We get out the classifications and the counts of starts. So, I mean, and so like for us to run, once I get that to run production is like less than 5 minutes for that. So it's pretty quick.
Thank you. Okay, we will take the last question from the room, please.
Andrew Reamer, a observation and ask Jed to comment on it. I think the first blended statistical agency was the Statistical Clearinghouse in the First World War, run by Wesley Mitchell. And because the government was setting prices and they had to pull data from all sorts of sources to come up with indicators to set the prices. And so after the war, Mitchell and Edwin Gay, his partner, went to President Wilson and said, let's put this agency in commerce. Like, let's create a blended data agency to pull this data together. And Wilson said, no, we don't need it. And so the result was NBER. Gay and Mitchell set up NBER, and I'm imagining the word bureau is in there because of what their intention was. So, and Mitchell was the one that brought Simon Kuznets into the Commerce Department to do the economic accounts that became BEA. So there are lessons to be learned from this, and I just put out that history and let you comment on it if you want.
I'll just add to that. So the EIU was actually founded in the wake of World War II because people wanted to invest in Europe and there was not good data. And so the EIU was formed first to help the newspaper have good data so that it could report. But then subsequently, it was pretty quickly realized that this was a viable B2B business to sell businesses data about these economies. And of course, now we've expanded to 200 countries and 6 industries. But that wake of World War II, I think, spawned a lot of data collection, data agencies, and data services around the world.
I am glad to know more of that history. Thank you.